Welcome to the Engineering Project Manager Podcast, dedicated to helping project managers to sharpen their project management skills. And in this episode, I'm going to be speaking with Kawaoka, who's a professional engineer, a founder, and also the author of The Wealth Elevator. And we're going to be talking about his journey from engineering to real estate investment. And we're going to be talking about strategies for financial success tailored for engineers, and also the influence of project management principles in your career. So Lane, can you tell us about your career journey and how you transformed your career from engineering construction management?
I started off like a lot of folks listening. We're all taught to go to school, study hard. I think I became an engineer because one day in high school, while I was Googling like the top majors that made the most money without going to more school, like getting a doctorate or a master's degree. And we all know it's like engineer, like mechanical, electrical, etc. So I was like, I'm going to do that. Maybe I happen to be good at math too. So luckily, I was that problem-solving mindset. But yeah, when going through college, I was really never good at any of those math problems. I became one of those industrial engineers, which is the jack of all trades or perhaps master of none. And just went into my career as a project manager because I was never really a technician or one of those design engineers. Started working for a Fortune 50 transportation company, started to build their infrastructure. And that was how I got into it. And I think as most young professionals getting into their careers, they throw you into less enviable jobs. I traveled all the time for work, from Texas to Nebraska to the Washington Cascades, and just led construction crews. A lot of people ask, what the heck do you need a degree to lead a crew of 40 guys who were like your grandpa's age? But that was the way that this company did it. And I look back and I think that was probably pretty good for myself, built the leadership skills, and then developed the engineering was always to learn on the job after that.
Okay. Yeah, it's really interesting that you said that, because I think that my journey is not exactly the same as yours, but I think I can definitely relate to you in regards to like math and stuff. And the fact that I didn't really like the technical side of engineering. I was more so into the old construction management side of things. And I can definitely also agree with your point where you're saying, yes, you absolutely did need a degree for construction management training, but like the leadership skills that you learned there are really second to none. So I think that we can definitely relate there. So let's talk about your book now. So you have multiple books, right? And what are some key takeaways that readers can expect, especially with this second book that you have out here now called The Wealth Elevator?
I didn't like my engineering job, and I was always searching for a way to get out. And I was always travel hacking and credit card hacking. That's a lot of stuff that people will do, or I did in my early 20s. And you start to hear about this thing called like rental real estate. And I bought my first house to live in. I was never really at home because, like I said, I was traveling all the time for work. So what I did was I just started to rent out my place. And that first property I bought, I think it was like, I needed $70,000 down payment. So it took me like a couple years to save that up. And I just threw a renter in there. And this is where I discovered like this world of real estate entrepreneurship. And I was like, wow, I'm making money 4 ways. Through the tax benefits, the mortgage pay down, the fact that my tenants getting my equity built up for me, and the appreciation. I was making like 20-30% plus a year of my money. We got a lot of math-based people. I don't really want to get into it too much, but I do a little whiteboard exercise on my YouTube channel if you want to check it out at thewealthelevator.com/returns. But I was like, why the heck am I like putting my money in this like 6 to 8% stock market stuff that goes up and down like a roller coaster when I'm making like triple, quadruple plus with very little effort? And that was where I realized that the wealthy do things very differently. Fast forward, that I bought my first rental in 2009. I bought 11 rentals by 2015. But this is where I hit an inflection point, a paradigm shift, if you call. Or in my new book, The Wealth Elevator, I described that there's different floors of the wealth building journey. First, a lot of people, I think, listening, you skip over what we call the basement, right? The basement is, I think, a lot of financial books out there that are written for the masses. Quite frankly, broke guys without decent jobs, they can't seem to save very much money. And That's where you need to build a budget. I already had that when I graduated college. When I was on that first floor of the wealth elevator where I needed to buy little rental properties, save up 20, 30 grand as a down payment on a house. And I was buying these properties in Birmingham, Atlanta, Indianapolis. And like I said, I bought 11 of them. But that was where once I reached accredited investor status, which for folks who can, if you guys want to Google that online, it's essentially your net worth of $1 million or greater, or you have a salary of over $200,000 a year, which a lot of engineering managers have that. At this point, you're able to skip right into syndications and private placements where you don't have to be the operating manager in charge of the asset and take on the legal liability and the debt in your own personal name. And this is where I traded in my houses and went to these larger syndication deals. So not quite like Monopoly, but in a way, you switch into a different type of movement. But I put this all in my book. That was almost like 15 years ago in my early 20s, and wanted to retell the journey because there's not very many, to me, there wasn't any books talking about this private placement and syndication world of all these country club type of deals for people to get access to. And there was really no book that came from the perspective of, hey, there's different floors of the wealth elevator. The folks will love it here that I have all these like charts and flow charts in the book describing all these different floors. So all you got to do is look up your net worth or like how much money you're cash flowing today. And that's really where you fit. And that's the corresponding strategy in terms of, do you do a 401k? Do you not? Do you get your Roth IRA going or not? And then what are you investing in? More alternative investments such as real estate or private equity, or more of the traditional stuff like the stock, bonds, mutual funds, the standard sad American investment diet. But that's essentially what the wealth elevator is, this construct to do.
I've done like a bunch of reading, a bunch of different books about like wealth creation and like how to really start from zero, from the basement, as you just mentioned here. And definitely this book is something that I have to get onto my list now. So let's take this and now let's actually start to make this something that's tangible for people that are watching this here. And let's talk about some strategies that engineers in particular can use to elevate their financial aspirations. So for the average engineer, the average person that's in the AEC industry that may be starting from zero, or maybe they don't have a background in finance, or maybe they didn't have parents that help to educate them from the jump, where can they start?
Yeah, this is why I was so excited to speak to the group here, folks that understand math and aren't afraid of it. The truth is you don't need to be a math whiz or a finance wizard to do this stuff. Most of us who play around with spreadsheets that are on our spare time are going to be well equipped in terms of the mental aptitude to be able to do this type of stuff. In fact, in our world, the vast majority of the professions are engineers, strangely enough. I always thought, because the second agreement was engineers aren't paid very much. You're never going to drive the Rolls Royce by being an engineer and following that career path. A lot of people listening, you're not in the basement, right? You make at least $50,000 a year and you're net positive. We probably place most of the folks listening on the first floor, which the name of the game is to buy rental properties. And therefore the name of the game is to throw it into a analyzer, right? And everybody here in their comfort zones, the spreadsheet world, on a high level, when you're looking at a rental property to buy, you're looking at the numbers first. If not, don't even waste your time looking at it or looking it up on the internet. So one quick rule of thumb is called the 1% rule. So you take the monthly rental price and you divide it by the purchase price. So for example, we like to invest in Houston and Dallas a lot, right? Because your rental value ratios are a lot stronger there than a primary market out in California or New York or Hawaii. Primary markets are your cool places to live. The numbers aren't going to work here. Out in California or Hawaii, you'll be lucky to buy a $500,000 house that'll rent for $2,500 a month. So the math is $2,500 divided by $500,000 is 0.5%, which is less than 1%. No bueno, not going to work. When I first started to buy these little rental properties, it was in secondary and tertiary markets like I said, Birmingham, Atlanta, Indianapolis. Some places people go is Memphis, Kansas City. Here you're able to buy like $100,000 house in an okay area that will rent for about $1,000 a month. So the math is 1,000 divided by 100 grand. That's 1%. Now, another rule of thumb here is you try to buy properties that are at the 80% of median homes. So I think where you're at, Matt, average home out there is what, 150 grand for 3-bedroom, 2-bath for lower middle class folks. So you take 80% of that, which is a little bit lower on the scale. And that's a good renter class type of property.
Got it.
So the 1% rent to value ratio is not like the complete due diligence, but it's a quick and dirty way of figuring out where most of our clients live in high price areas because they make a lot of money and therefore they have to invest outside of their home state. As the saying goes, live where you want, like how I live in Hawaii, but invest where the numbers make sense. Other things is we try to invest in red states, nothing politically, but like places like Texas, they reign on the rule of you don't pay, you can't stay, which is better laws for the landlord. When you're the landlord, hey, you want the rules on your side. And additionally, you typically don't buy properties in, I'll define like A class, B class, and C class properties. A class are those higher end areas, places like my daughter would go running at night for leisure. B class, maybe it's okay to hang out during the daytime, but you don't go lollygagging during the evening time. C class, you try not to really hang out there at all. I'll use very key words here because I know people are smart listening. We try to maximize the amount of cash flow by optimizing the least amount of class of the area. We don't want to be slumlords, but you're not going to find cash flow in the class A area. There's a bit of a sweet spot in the B class type of area for landlords like us. But people want to geek out on more of the full analyzer. They can grab that on my website for free at thewealthelevator.com/turnkey. And start to go to town on the whole spreadsheet and all the all the expenses. This is why I think engineers initially gravitate to this. And oftentimes, like I have to talk to non-engineers and be like, "Hey, man, don't worry about it. It's fine. Don't get fearful of this spreadsheet thing, right? It's not that big of a deal, but it is a numbers base."
Yeah, and I think that another part of it is just that, I mean, like real estate is so big. Like you have the numbers aspect of it where you're doing the financial analysis. You're looking at what your return on investment is going to be, but then you also have the real estate development side of things where you can actually go and possibly become a general contractor in its different areas of residential construction. Now I want to get into talking about your background in engineering and construction management and how that's influenced your approach to project management with real estate development.
When we would start to invest in real estate, we'd buy little rental properties, and then we'd buy these 50-unit apartment complexes, more Class C type of assets. And we later learned that we could create more value and differentiate us and beat our competition by developing. And that was what brought me into my past life as an engineer. One key thing, if people's takeaway from this talk is like, focus on what your business is. And your business is not your job working for the man. That's you trading your time for money right now. But make no mistake, your business is your personal finances. That's what's going to feed your family. That's what eventually is going to get you at a point where you can buy investments to quit the rat race. And this is what frustrates me a lot and why I wrote the book, is there's so many very great people and hardworking folks in the middle class, which is a lot of you guys out there. And the middle class is shrinking. They're becoming endangered species. And it's getting to a point where it's not the rich people, the wealthy, that pay taxes, because we teach people how to not pay taxes by these investments. And it certainly is not the poor people, right, who just get the government handouts, the poor middle class in the middle, which I used to be a part of. And a lot of you guys are, that I want to help out the most, because it's you guys are the ones powering America forward with your heart, sweat, and tears. But very early on, I realized I wasn't a very good engineer and I needed to get myself out of the rat race. And the only way I was going to do that was build my personal portfolio so that I could eventually fire my boss and do what I want. But going back to my career, first most of my career was working for private industry. My spouse asked me what did you do at your job? I mostly pushed paper, right? In terms of we had contractors and consultants to do a lot of our engineering work. So I was in the owner's seat for most of my career, vetting consultants, awarding contracts. And one of the biggest tasks that I remember doing that was probably the most annoying was choosing vendors. And it's easy to choose vendors, which one is the best bid or best value. But then you got to do all this other BS to justify it, especially when you get into the government domain, which that's where I later moved towards in my career, working for the city and then state and then federal government, right? So I've hit all the trifecta right there and the brain damage of all the government red tape in that. And unfortunately, people have stolen money in the past, which is why they have all these rules. But that allowed me to look at things from a different perspective and gives me a lot of appreciation today that when we make a decision on a contractor or an engineering consultant, that we make the decision very swiftly. Zero red tape. We don't make some stupid matrix to identify why the best bidder was better than the fourth or fifth one. We just make it happen. Part of that is to live and die on the decision. It's our own money and skin in the game. And we also take the upside. And this is one of the big appreciation, being aware of all that nonsense that could have taken place. There's always a really smart person on the job site or in any project. Typically, that's the superintendent or the white collar professional engineer that's in the office. That's the person that just makes the project happen at the end of the day. Unfortunately, that person is only paid about $100,000, $200,000 a year, and they get some type of maybe bonus by hitting schedule and budget. But the people that are making a 7-figure paycheck on that project are the investors and the developers. And maybe this is a bad thing, but I want to pull back the curtain on the whole Wizard of Oz situation. Unfortunately, the people who deserve the money the most, the engineers and the superintendents, aren't being paid beans based on their compensation to the project. But hey, that's what it is, right? College creates a lot of engineers by the dozens, by the hundreds, thousands. And there's not very many people who have the seed capital to do the projects on their own. But if they did, and they built up their portfolio slowly on the side, start off as a side gig, buy a little rental property, you'll eventually get to that plateau if you want to get there.
Yeah, that makes a lot of sense.
But in the meantime, buy a little rental property or two and get ascending up the wealth elevator.
How have you used project management principles specifically?
Yeah, so when I used to own little rental properties for a lot of folks on the first floor of the wealth elevator that make professional salaries over 80, 100 grand, your time is better spent not messing around with the property and focusing on your day job, whether you are engineer or doctor, dentist, etc. So you employ property managers. The way this works in the industry is like they'll typically take maybe 10% of the revenue and some extra revenue when they get a new tenant in there for you. But these guys' job, do your dirty work for you. Find the tenant, lease the tenant up, vet them, right? It's them taking on their industry knowledge to do that if something were to get broken, which happens quite often, right? And I think this is why people get out of rental property ownership after they become an accredited investor. When I had 11 rental properties, I had maybe a big catastrophe that happened every quarter on 10 properties, 10, 11 properties. And it can be simple fixes. It can be huge renovations, $10,000, $30,000 scopes, which I guess isn't huge, right? But it's always kind of small things here, there. But most times the property manager has the solutions. They hire the contractor for you. In a way, they're your project manager. This is not rocket science we're talking about here. But your job is, when you're a little rental property owner, is to manage the manager. Hey, when are you going to get that guy out of there? When are you going to fix that drainage issue? When are you going to fix the piping issue? And staying up on them. It's just project management 101, essentially, what's going on here.
Yeah.
And that's the name of the game, which is very doable, I think, for most people with a handful of rental properties. But when you cross over maybe 10 or 20 rental properties, that's where I think it becomes more of a job and a low-paying job at that. And I think this is where if you were listening here, wow, you got 11 rental properties, you're rich. So with a few $100s of cash flow per property times 11. That's $3,000 of passive cash flow a month. Now, I'm not complaining about this, right? But most of our clients are looking for more for passive cash flow in at least the $10,000 a month range. So you're going to need 20 or 30 of these rental properties, and that becomes a huge headache. And that's when you step up to the second floor of the wealth elevator and you start to go into syndications and private placements as an LP. And essentially what you're doing there is you're getting the asset manager to manage the manager for you at that point, and who will also have skin in the game, which is the big difference between traditional investments in the stock market, right? Those guys don't have skin in the game, and they have
Got it.
huge hidden fees in the regular brokerages out there, the Fidelity, Vanguards, etc. It's a way for the Wall Street to get rich and ultimately take all your hard-earned profits in the process, where what I'm advocating for is investing in your own stuff. Maybe you got to be your own project manager for a little bit, but eventually you scale up and you get to a point where you hire an asset manager, where we might take down a 50 unit or 200 unit apartment complex. We have property managers. And when you get into that world, you're talking about more commercial property managers at that point. They have the luxury of having the staff all in one place to manage them. And it's economies of scale. It's the same thing times 200, 300. And they can just go through and rip and roar through the property scope. And most times when we buy these types of assets, there's some type of what we call forced appreciation ability. So just new flooring, new appliances, new paint job. It's a lot of supply chain, right? Getting those types of materials in place for the property manager to go through it. And we don't kick out tenants per se. We just, as the natural tenant flow goes through, maybe 10, 20% of the tenants every month in the hot months. And in the slower months, maybe less than 5% of the units turn over. But as soon as those new units naturally turn over, and the property management team goes through and does those light rehabs, and then we bump the rents up slightly. A lot of people look at the home rehab shows, right? Which is a very over dramatized, right? What we do is more of a slow flip that can take 3 years, 5 years to go through.
So let's get into the risk management side of this. So how can you make sure that the investments that you make, whether it's a single family or multifamily deal, how do you make sure that those can withstand market downturns? Because obviously in our economy right now, house prices are raising, but interest rates are also pretty high up as well. So how do you prepare yourself for either an impending market downturn?
For example, on your little rental property, you need to have enough buffer in there, namely buying the right properties, so that when you do have a vacancy for a month or two, that you can cover that with your cash reserves. And that's maybe simply as throwing it on the vacancy line, instead of 4% a year, jack it up to 8% and see what happens. And I think this is something that a lot of the folks listening are very well versed at, which is sensitivity analysis, is what we call it. But on the bigger stuff, on the commercial assets, there's a few other levers that we will pull on the spreadsheet to stress test the deal. The big one is this thing called reversion cap rate. It's a hugely discussed item within the commercial real estate world, where you need to assume what kind of market you're selling it in. Obviously, you try to assume that you're selling it in a weaker market than it is today. So there's a number on the spreadsheet where you're dialing up or dialing down the hotness of the market. People want to get access to that syndication LPE course. We discussed this in great lengths. Another one is like the occupancy. You're not going to run your asset at 95% occupied. And even if it is occupied 95%, not everybody's going to be paying, right? So you got to add in there what's called economic vacancy. So your deadbeats in the building. We've had it as high as like 20% of people don't pay, right? And that's in a little bit rougher type of asset. But you need to assume for that. You most times, like in underwriting 101, you say to assume for maybe 10% of vacancy, an additional 3%, 4% of deadbeats. And that's not an official term, but I think that's a term that most people will understand here, which is called economic vacancy. So you're showing the asset truly performing at about like the mid 80% efficiency in a way. But like I said, when you play around with your spreadsheet and you try and stress test the deal, you jack that up to maybe you put it up to 80%. And if you're still cash flowing at that point, because you've locked in your debt for a long term, you should be fine to ride ups and downs of the market. Now, if you've had floating debt or loans that renew in under 3 years, then you could be vulnerable to market undulations that happen. And I will say that if commercial real estate has been rocked 2022 to 2024, it has gone down 15% to 50% in some places. You mentioned you're in Houston. Houston has gone down 30% off the peak.
Wow.
If you're unaware of this, you're unaware of it and you need to get into the know. And this is an excellent entrance into the world of commercial real estate. A little bit different dynamics in residential real estate. We try to stay out of residential real estate because it is very much based off emotion. But we like commercial real estate, and I think a lot of people listening should like it because it's based off the numbers. What is the asset operating at divided by the prevailing cap rate, and that's the market value. So you have control over that net operating income, which is income minus expenses. So if you could do something to the property, I know out there you guys have a lot of hailstorms. We'll build some of the parking coverings and charge people an extra $50 a month. We try to buy the properties with those awnings already in place, and we have to build them for 20, 30 grand. We just do simple things like start to charge for that type of stuff, and it drives the income up and thus the net operating income up, which drives the property value up. If I'm able to charge a few parking spaces of reserved parking or covered parking and make an extra $1,000 a year off of that, the math is very simple. The math is how much did you increase the income by divided by the cap rate, which most times let's call it 5%. So $1,000 divided by 0.05, just something as simple as increasing net operating income by $1,000. I believe that's 50 grand. You just created 50 grand of value right there.
Yeah.
That's some dude's salary in 1 year just by making some small management decision. Yeah, let's rent out those 3 parking spaces right there. And now that's the power of commercial real estate and how it's based off of the numbers.
So as we wrap up here, I just want to ask you for any more advice that you might have, how you can leverage your project management skills.
When you're starting out on the first floor of the wealth elevator, the name of the game is buying rental properties, and you're going to have to get your hands dirty to some extent. I do not advocate for doing the buy, rent, rehab, get into that game. I think that's just too much risk, especially on your first several properties. I think there's a lot of websites and books out there that advocate for that. I speak more towards the people who make decent salaries already. And especially when you're first getting started and you're not very experienced, I would just keep to just the simple buy and hold rental properties. So make sure it cash flows from day one and it's a good purchase and it works in your analyzer, and just start from there, get started. And we didn't really get into the taxes today, but that's real estate is the way that people pay zero on taxes. If you make $200,000 a year and you save a quarter in taxes, you just save a few months of your paycheck you just created right there by saving taxes. So this is where real estate goes hand in hand with taxes. So you don't even need to do any rehab to do that. That's just being a buy and hold investor. So I think what I preach a lot is what's the 80-20 in this? What's the Pareto's law of this whole thing? What's the low-hanging fruit? And a lot of that is just getting started, buying that first rental property and getting moving from there. And this is not the get rich quick scheme though, right? This takes a long time to go over in the background, and don't quit your day job. You keep working the day job. That's going to how you power this behind getting all these down payments. But eventually, like how I had, took me 7 years to get to a point where I started to hit that hockey stick of wealth growth and the properties appreciate, and you get the option of moving your career or stopping your career. Like I said, early on, I went for maximizing my pay with working for a private company. And that's not very good for quality of life, as we all know. But later on, I switched jobs to find working arrangements like with the government, which is a lot easier to work with, quite frankly. And that was where I was for a bit. I had a good quality of life. I got to buy rental properties on the side. I was aggressively increasing my net worth. Obviously, today we run a real estate syndication company and we educate people how to do this. But this is where not most people, if I didn't do my podcasts and have this whole education company, I'd probably be hiding out in some engineering office and just chilling, to be honest.
Yeah, I get that 100%. I think that's great advice. Really, thank you for coming on. Could you give us like a list of all the different resources that you've listed in today's episode?
If you're looking to buy little rental properties and you're looking for that real estate analyzer, they can go to thewealthelevator.com/turnkey. If they're already an accredited investor and they're just looking to just jump on deals as a passive investor, they can go to thewealthelevator.com/syndication and read that little white paper there. Check out the new book releasing on Amazon later, also called The Wealth Elevator.
Awesome. Well, thank you, Lane. We really appreciate having you on.
Thanks for having me, Matt.